Hey everyone, glad to be here. Barry Burns here with Top Dog Trading. Let's see. Oh, cool. Now I can see questions. Awesome. Awesome. There we go. All right. So, everybody, let me know if you can see my screen. Should say, welcome to the Top Dog Trading webinar, the best 3 volume patterns to trade in today's markets. If you would acknowledge that, then we'll get started. Eric Latig, great, thank you. Awesome. We got it. We're rocking. All right. All right, everyone. Well, fantastic. I'm excited to be here. Thank you all for being here today on an early morning. And well, I guess it's afternoon in some places. Just kind of depends where you live in the world. I'm in Los Angeles, so it's not too early here. But markets have been trading for a few hours here, and of course, overall, well, they're not doing so good today. S&P down, Dow down, Nasdaq down. Dow is right now down 175.68. So, well, be interesting to see what happens out of this. But for today, what I want to talk to you about 3 volume patterns that are working for me today. This is what I personally trade. So I'm not giving you some old has-been stuff. I'm giving you real stuff that I use right now. By the way, if you listen to podcasts, I've got a podcast, and obviously it's absolutely free. Check it out, the Top Dog Trading Podcast. It's on iTunes, Google Podcasts, Stitcher, wherever podcasts are, I'm there. And we get really good feedback from it. People seem to really like it, and I know I love doing it. So check it out. It's free education, and hey, why not? In fact, it's been so popular. We actually, I haven't looked lately, but last time I looked, we were at number 10, and this is iTunes, and we even got ahead of Jim Cramer's Mad Money, which is kind of crazy because he's a pretty big deal. Ahead of Tony Robbins, Wall Street Journal, Rich Dad Poor Dad. So I don't know what's going on, but people seem to like it. So I'm happy. So check it out, enjoy, and it's my gift to you. Here's our legal disclaimers. It's important, even though you've probably seen this several times throughout the day. Still important, I think, for each presenter to show it again because people come in and out of these kind of multi-speaker presentations. So I just want to put a little slant on this to help you understand this is not just legalese. A lot of people overlook this stuff and don't read it because they're like, oh, yeah, I've seen that before. And you have seen it, but think of it as education because that's what it really is. The regulators have done us a great service by going out and finding out why most people lose money trading. So review it, and you can learn from it and be one of the people who make money trading by avoiding the mistakes that most people make. Okay, so back on today's topic here now. Trading, really, when you distill everything down to it, it's about supply demand. It's about supply demand. That's what makes the markets go up, more demand than supply. What makes the markets go down? More supply than demand. So it's pretty much that simple. Now, what measures supply demand? The best thing that measures it is volume. That's the actual number of contracts, shares, lots, whatever that are being traded on each side of the market, the buying, the selling, the bid, and the asking. Now, in general, we're going to start out with basic stuff here today, just because, well, probably got some new people. And what I want to share with you here is the foundations, and then we're going to get into some more advanced stuff. So whether you're beginner, intermediate, or advanced, I got some stuff for you today. So here we're going to start out with volume 101. In general, volume increases as the market moves up, indicating a rising demand and a lower supply. Volume or increasing volume as the market moves down increases rising supply in low demand. So lots of selling, lots of short selling. So just to put some graphics to that, some charts. In fact, GoToWebinar's got a nice little spotlight tool here. There we go. So price going up, and that is supported by volume going up, and that means that price is going up on strength. There's, a lot of demand for it, and therefore that is a good indication that, okay, probably going to be some more. A little pause in the market, that's normal. Doesn't always just go straight up or down. Usually ebbs and flows, has little oscillations up and down. Not much though. Actually, it doesn't even go down, just goes sideways here. And volume comes out. All right, so people are kind of probably taking some profits. People are maybe some retailers are shorting, but that's not going to do anything to the market because the volume is so negligible. And then when big volume comes back in, boom, market takes off again to the upside. Okay, so pretty, right? That's pretty intuitive. Pretty much everybody can probably understand that. Next level is still pretty basic, but maybe just a little less intuitive. But as the market goes down and volume goes up, that shows bearish supply demand. So there is more people shorting, and that's why the volume comes up. So you get them moving in opposite directions. That's why it's a little less intuitive, but still same concept, right? So we've got a strong down move. Think of it that. Are we moving up or down on strength or weakness? And in this case, volume indicates either way, it's moving up. The previous slide, moving up on strength, this slide moving down on strength. Okay, now I'm going to show you these three volume patterns. So here's the first one. Now that we have our little basic concepts in place. So volume, this is number one, a volume pattern that keeps you on the right side of the market, even against the trend. So contrary to what we just saw, here we have the market moving up, price bars, price action moving up, but volume is not moving up as we saw in the previous slide. In this case, volume is actually trending down. Well, that means there's not a lot of demand. And so this is, yeah, price can move up on decreasing volume. And what does that indicate? It indicates a weak trend. Weak trend. I remember back in the days of yore when I first, well, not first started trading, but after I was trading for a little while and losing truckloads of money, I hired a coach, hired a mentor, and I said, hey, what the heck's going on here? I'm trading these trends. Trends are supposed to make you money, right? The trend is your friend. And he said, well, look, let me see some of your charts. So I showed him some of my charts and he said, I see the problem. And he asked me a question. And he said, before I even show you how to analyze this, I want you to write this question on a post-it note and put it on your monitors where you trade so you will see it every single day when you're trading. In fact, he said, this question is so important, I want you to ask yourself this question before you take every single trade. And I said, all right, what is it? He said, here it is. And by the way, my friends, you might want to write this down and do the same. He said, here's the question. Is this a strong trend or a weak trend? Well, I really didn't understand what he meant at the time, but here's what he meant. This market's moving up on weakness. So if we come back to a retrace, that's what I was doing at the time. I was doing trend retrace trades. And it comes on back down. Would I want to go long here? Well, the answer is no. Why? Because we're going up on weakness. This was not supported by an increase in volume or demand. So yeah, markets can go up on low demand. They are not necessarily correlated. And when they do not align, in other words, price does not move up on increasing volume, that is a warning. That is a warning that do not continue to trade this trend, even if it's early in a new trend. That early trend will probably not be sustained. And that's the case here. So this is a volume moving down against the trend while price is moving up, volume's declining. Then on the retrace, now that's the other key. Normally we're looking for on a trend, price to be going up, volume to be going up. And then on the retrace, like we saw before, volume came out of the market. Well, look what happens here. On the retrace, volume comes into the market. We get an increase in volume on the retrace. Well, follow, goes back to the old saying, follow the money, honey. So don't just follow price. People who say, well, they're just pure price action traders. Reading pure price action is very important. I'm not against it, I'm for it. But combine it with, okay, who is trading? Is it the big money or is it the little money? The big money is going to dominate. And so as it comes down on increasing volume. That is indicating to me that, oh, Actually, this market is in a bearish mode. We're in a bearish sentiment here. Retailers were able to push it up enough, but the professional money came in and they're shorting this puppy dog. They're shorting it. All right. And so what do I want to do? Do I want to trade? Now, when we come back up, we come up and there's low volume here. And then when it comes back down, big volume again. So what's volume? The money. What do? We follow the money. All right. Oops, got to reactivate this slide here. So that's pattern number one. Pattern number one will keep you out of trend trades that otherwise look pretty good, where the price action looks good, but the trend will not follow through. So that's that's volume pattern number one that I promised. Volume pattern number two today is a counterintuitive volume pattern. And I got to tell you, this thing has made me so darn much money and continues to, that it's just crazy. So here it is, a counterintuitive low volume pattern that provides reliable entries. Most people, when they're trading volume and they're looking for big volume, that's awesome. In some cases, that's what we want to look for, such as the case we just looked at. But low volume patterns can provide you with some really, really, really good signals as well. So here is one of them. Trend going down, long-term trend. Now, the first step in this, by the way, is, again, we're not trading just price, and we're not just trading volume. We're putting the two together, and that's the key. Put the two together, all right? So we've got an extended trend. That's step one. So price action, very important, absolutely critical. And you know the old saying, the trend is your friend until the end. So what does that mean? Well, it's based on a mathematical model that the longer a trend continues, the less likely it is to continue. So we trade early in a new trend. That's your highest probability trend trade. But then we need to add to that, is there a lot of volume coming in with it? And so we saw in the last example that no, there wasn't. And so even though we were early in a new uptrend, we would not trade a trend continuation. In this case, now it's the opposite. We're not early in a new trend, we're late in an old trend. And that's step one for this approach. So the trend is your friend until the end, meaning that the end of a trend, or the trend is your enemy the longer it continues. So then we look for trend reversal trades. Then we actually do look to trade against the trend. So trend's been extended, going. Okay, now we look for a trend reversal. Now that is tricky, and most people will tell you it is more challenging to find the end of a trend than it is the beginning of a trend, and that is absolutely 100% true. So here's one of the things we look for in order to do that. We got an extended trend. Now we can start looking for reversals. We get a volume spike. Okay, that is an exhaustion pattern. Lots of people know that. Nothing new there. But here is what I'm adding to it today. I like to wait for those exhaustion patterns, climax of volume after an extended trend, and then I like to see price action retest that. I like to see it come down and test that low. And as far as price action goes, my ultimate favorite scenario is when it breaks below that low a little bit. Not just gets to it, not just gets above it. Those can be good, valid signals as well. I prefer it if it gets a little below that low. That indicates stop running, and that's good. A lot of people will be maybe trading the breakout to the short side, and they're going to get trapped here. So this is a beautiful thing when you see this. Now, that's price action. But then we got to combine it with volume, low volume. So very few people are getting in here. Now, here's one of the cardinal rules of professional trading. Professionals get in before amateurs. So we could wait for price action to put in higher highs, higher lows, higher highs, higher lows, see a trend, and guess what? That's what everybody and their parakeet is doing. Then you're getting in with the retail traders, the amateur traders. Professionals get in before that. We look for signals before they're obvious to everybody. So I'm looking for this low to be broken just a little bit, not a lot, just a little bit. and low volume after an extended trend. So remember, you got to put all those parts together. That's the key. And then kablambo. And yes, that is an official technical analysis term. Very few people know, very few people use, but kablambo, if you ever hear anyone say kablambo, you know they're a pro. You know they are. All right. So that is pattern number 2, numero dos. All right. You know what? God darn it. I need to, I can't use my spotlight and change slides at the same time. So here's another example. Just this one is on an intraday chart. And let's see here. There you go. Just to show you a little different perspective here. Same kind of thing. Shows you that it works for day trading and swing trading. So market comes down, big move down, lots of volume. Price goes up, look for a next cycle high, and look for it to come back down. Now, in this case, we have a little different scenario in the sense that we did not break these lows. So as I mentioned, we're looking for either for it to, well, we want it to retest this, which it does. If you look at the real bodies here, we're kind of in that general zone. I would prefer it. I think it's a higher probability trade if it breaks below there a little bit. This time we don't get that, but it still can work. Low volume, point is it retests it, and back up it goes to the moon, Alice. And that's what we want the market to do, right? So ways to get in early. Now, look at this. Here's where a lot of people will get in. They would get in when the market breaks this high because they're looking for higher highs, higher lows, and that sort of thing. Not bad, not a bad approach. It's just a little late to the party, that's all. So if you're waiting for it to break through this high, guess what? Yeah, volume comes in here now. That's because, yeah, lots of people see this now. And that's where most people are going to get in. Do you want to get in where most people get in? No, you do not. Because most people, what do they do? What kind of results do they get in trading? They lose money trading. So if you want to do what most people do, you're going to get what most people get, and it ain't good. So as professional traders, we'd rather get in before them. And then when they do get in, well, they're just adding to our position. And by the way, if you got in here, it goes up a little bit, comes back down, comes back below that low or below that high, by the way. But again, this is just, I cannot express to you how important this is. So we've got now, it goes above that resistance. And now people say, well, resistance then becomes support. It does. That is true. But in today's markets, it's better, actually, it's a higher probability to trade if it actually retraces a little below that new support and doesn't go right to it. Notice, by the way, it comes to it here, gets pretty close, goes up a little bit, and then breaks that low. That's the one you want. Not that one, that one. And again, this is where the amateurs get in. This is where the professionals get in. Because here it looks like, oh, that support didn't hold. Actually, it still did. We're still holding it. Support resistance levels are zones. They're not lines, they're actually zones. And professionals like to get in both below the lines of support and above the lines of resistance, knowing they are zones and knowing that amateurs treat them as lines and they get stopped out. So very, very, very important stuff. All right. Well, I basically covered all of this already, so we can go on to the next one. So the third price pattern that I want to share with you today, and then I got some bonuses for you, some bonus price patterns that are really cool, and that's going to be for the advanced people. Actually, some of this is advanced too now. I consider this intermediate level, actually, and then we'll get to the advanced stuff. So here's a mismatch between price and volume that leads to explosive market moves. And when we are trading, we love the market to go into explosive move after we get in, obviously. So this is called a squat bar. So again, price action comes first. Price action, this red line, by the way, is the 50-period simple moving average. This black line is the 15 exponential moving average, just so you know the moving averages I'm using. And I consider the well, here's how I use them. The 50 SMA I use as a line on the sand between a bull and a bear market. The 15 EMA I'll use as a kind of a what we call it, like a relative strength level. So, for example, here we're above the 50 MA. So I say, okay, we're in a bullish sentiment right now. For it to stay bullish, I'd like it to stay above the 15 EMA. In other words, as it retraces, so strength up, weakness on the retrace is what we want to see if the market's going to continue to trend up. It doesn't hold the 15 EMA. It breaks below it. So that's a problem for being long. We want strength up, weakness on the retrace. Strength up, weakness on the retrace. Here we get strength up, but then strength on the retrace. Oh, again, volume is now, we've got volume as we come down, big volume. That's bad for buyers. So that shows a shift of the money transferring from the strong hands to the weak hands. So now we're no longer bullish, even though we're above the 50 MA. 50 MA is very slow, right? It's just one thing we put on the map of our charts. Then we get what I call a pinball pattern. It kind of just bounces around here between the two moving averages. When it breaks below the 50 MA, that's when I consider, okay, now we have officially broken into the bearish half of the chart. And then on the retrace, I want to make sure again we have weakness on the retrace, and that is defined as being held by the 15 EMA, so that we're not getting a lot of strong buying come in. All right, so because again, you look at price and it's like, okay, let's see. Well, looks like there's some little bit of volume coming in here. I mean, it's all relative, right? And that's one of the tricky things about reading volume is, what's strong, what's weak, because it's all kind of relative. So looks like, okay, volume picked up a little bit here, but price didn't go anywhere. So as long as we hold the 15 EMA, we're good. Now, here's the squat bar. The squat bar is defined as a narrow range bar right there with big volume. Well, that's kind of unusual. Usually when we get big volume, we get a wide range bar, but not here. Here we get lots of trading going on. If I could get my mouse to stay still. Golly, it's moving without me even touching it. There, stop. Okay. So we get a narrow range bar, but we get some big volume. Well, again, that's a little bit counterintuitive because you would think when there's a lot of buying or selling coming in that the price action would move a lot, but it doesn't. So what that represents is a lot of pressure building up. Lots of people coming in, price not changing. There's lots of people holding that position, and this baby is going to pop one way or the other. So think of it as a pressure cooker. And that's why I say it's a mismatch between price, narrow range, volume, big range, that leads to explosive market moves. In which direction do we trade it in? That's always the big question. Well, I trade it in, the bottom line is I trade it in whichever direction it moves. But I'm going to expect it's going to move down because, again, we're in the bearish half of the chart. We've had a weak retrace to the 15 EMA. And by the way, one other thing we don't have time to get in today, but I use multiple time frames. And so I will trade that breaking to the direction of momentum on the longer term time frame. That's my major rule on any type of expansion contraction patterns. So we've got a contraction here, and there's many other contraction patterns like, triangles, Bollinger Band squeezes, wedges, where we're looking for low volatility to turn into high volatility. And again, the big question there is always, well, which way do I trade this? My answer is I trade it in the direction of not the trend of the longer time frame, but the momentum of the higher time frame. I found that to be more powerful. Momentum is the strength of the market. Trend is direction. It's good. As we've already talked about it, we do use trend, absolutely, but direction can change at any time. Momentum is the force, the power, the volume, the strength, and that tends to show up sometimes either before trend or even contrary to trend when trends are going to change. So, all right, let me take the laser beam down here so that I can change slides. So here's a bonus, and this actually kind of reinforces one that we saw before, but just a little extra deal. Price comes down, makes a swing low, goes back up, makes it on big volume. So this would be a great place to put support resistance levels, in this case, a support level. And this again is professional trading. When price comes down, makes a swing low and goes up, and it does it on big volume, that's where professionals are marking support levels. And that's because the market participants have decided, at least at this snapshot in time, right at that time on the hard red edge of the screen, that, oh, okay, so we have found value. This is now feeling cheap to the markets, this price at 42 or 41, whatever, 75 or something. That now people are willing to come in and buy at that level because they think, oh, this thing's cheap now. I'm willing to buy at this price. This is a deal, or this is a steal. So I'm coming in. Now, so we mark that with a horizontal line, and then we look into the future and we say when price gets there again, now, again, will that be support? Well, we have to ask ourselves, it is a support level. Of course, then the next question is, will the market find support there again in the future, or will it hold support, or will it break through it? That's the question. Obviously, not all support levels hold all the time. Otherwise, the market can never go anywhere. So what do we do? Well, we look at price action and we look at volume to determine that. So we get a little bit of volume coming back in. It goes down, boop, comes back down again. Big volume coming in. There's your volume spike. And then it goes up. And again, look, it goes a little below that low. That's what I love about this. Love these trades. Love these trades. So I can't remember even when I first learned this, but then later I was taught the same thing again, retaught by a gentleman who was a floor trader in Chicago. And he had a special name for these, colorful name for them. But so I can tell you, the pros, this is exactly what they look for. And these have served me very, very well. So look for those. Seriously, you will not regret it. Okay, now bonus two. As I mentioned in passing, and now we're going to focus on a little bit more, is that volume can be, a little hard to read because it's all relative, right? You get these, what's big volume, what's little volume, in other words. I mean, some things are obvious like that. Okay, sure, that's big volume. But then you get, some bars in here that are just a little bigger, a little smaller than others. So sometimes people have a challenge. Well, how do I really determine what's big volume or little volume? So what I do is I like to add a 20 period simple moving average to the volume histogram. And there it is. You can use a different moving average if you want. If you ask me, well, why do you choose 20? There's no magic reason. It's not ancient Phoenician numerology. It just, it works for me. It's fine. You want to use a little different moving average? Go for it. But the point is, you want to use something that's smooth. You don't want to use a real short-term moving average. I don't like to use exponential moving averages or anything faster. Sometimes faster is worse. It depends on how you're using it. Most people think, oh, I just want the fastest indicator, no leg indicators, all this kind of stuff. In some situations, that is what you want. In other situations, it's not what you want. This is one of those situations where it's not what you want, because the function of it is we want it to be rather smooth because we just want it to be a line of demarcation between, again, big volume or little volume. So we've already got in this situation, it's not technically an indicator with volume, but we've already got an instrument here, volume, that is already kind of jagged, right? And so now we want to apply a smooth indicator to it to give us a smoother line of demarcation. So anything above, well, let's start here. Volume well below the moving average, we consider that low volume. That's it. Consider it like a line in the sand. So anything below it is considered low volume. So we went above the 50 MA, we're above the 15 EMA. Okay, price action is bullish, but god darn it, nobody's buying anymore. So now we're not going to expect this trend to continue. Comes down, breaks below the 15 EMA, a relative strength level, and it comes down a big volume that goes above the 20 period simple moving average. So we are in bearish mode now, even before we get below the 50 MA. So then roughly equal volume. So again, you're going to get, yeah, you could say, oh, well, that little green bar is a little higher than that little red bar. Too close. Doesn't matter. It's close. And so we just say, well, basically, it's roughly equal to the average volume of the last 20 bars. And therefore, volume is not strong, it's not weak, it's just average. So as we're coming down here, no real significant bullish pattern on volume, no significant bearish pattern on volume, it's just average. What do we do with average? Nothing. We don't want to trade average. We want to trade extremes. We want to trade when something really is going on. Okay, goes back up, still on average volume, and then boom, comes back down off of the 15 EMA on bigger volume, above the 20 SMA. And so that's our indication that already now we have a strong downtrend, a strong down move, because we've got our trending structure on price and the moving averages on bigger volume, supply, demand. So boom, down, strong downtrend. And that's what we want. Alrighty, so now we got some extra cool stuff for you here. So now we get into the advanced stuff. This one is more, what I've shown so far is really for anybody. Day trading, swing trading, you could do it for stocks, futures, forex, commodities, options, anything you can chart that has volume. The only thing I would say is you got to be a little careful with spot forex. Spot forex does not trade through a central exchange, so you do not see all the volume. Also, with most data feeds, you're going to be getting what's called tick volume, which measures the number of trades, not the number of lots. So be very careful of that when using volume with spot forex. One way you can kind of work around that, by the way, a little extra tip for you. I'm giving you guys a lot of extra tips here today. One way you can work around that is by even if you're trading spot forex, you can look at the futures foreign exchange currencies. And they do trade through a central exchange, and they do give you real volume. So that is one little workaround, a little extra bonus tip for you. Okay, now what we're going to finish with here today is this is mostly really for day traders. You could use this as a swing trader as well, however, on your entries. If you're going to be entering intraday and you're looking for a good time to get in, even if you're going to hold it for a long time, this is a good way to find optimal entries. But it's more of a like a scalpel tool, and it will relate to charts. We'll show you that in a minute. But for the first step, we're not looking at the chart necessarily. We are looking at the time and sales window. So as you see here, got TradeStation up, but time and sales, that's the window you want to bring up. So most trading platforms have a time and sales window. If you don't know how to access it, contact your broker or your software provider, and they can tell you how to access that in your charting platform. All right, so we're bringing up the time and sales window. What time and sales is this. It plots every trade that goes through the market. It's really what it does. And it tells you what time it goes through. So that's the sale. The sale, actually, let me bring up my spotlight again. So the sale is every trade that goes through, and then it gives you the time plot. So here's the time, and this is the type. Now, here's one thing. First of all, I edit my time and sales windows. So let me show you how I do this. So type. If you just default it, it'll usually show you every bid, every ask, every order that is put through. I don't want to see every order. You can do that, and there is a strategy for using that, and that's okay. But for today, I'm not looking at every order. I'm only looking at filled orders, because orders, bids, asks that aren't filled, I don't know if I can trust those. Those might be just, I don't know, people gaming the market. So I'm going to just look at, actions speak louder than words. And the action is, are you committed? Did you actually risk your money on this trade? And these are trades. So these are actually filled orders. Those I trust because, hey, people are pretty darn serious about their money. So they put their money on the line. And now I'm like, okay, now that person's committed. And there's the price, and here's the size. Now, that's the other key. So this one, I'm showing you the futures. You can do this with stocks as well. So what I did here though, and again, this is another edit. So I edit it so that the smallest size order that I'll see, each one of these is one trade, by the way. And I edit it so that I would only see trades of 20 contracts or more. 20 contracts or more in one trade, one person, one trade, 20 contracts or more. Why did I do that? Because I want to follow the smart money. I want to follow the smart money. So very few amateur traders, there are some, certainly, granted, that have a lot of money and still don't know what they're doing in trading. They made money somewhere else, and they might trade 20 contracts. But the vast majority of amateur traders, they're not trading 20 contracts. They don't have the account size to do that. So that's why I'm doing it. I am specifically doing this to look for the smart money. And I want to follow the smart money. So that's the whole strategy here. Now, here's where I said we can look at charts as well. So we can look at a chart, and by the way, there's an indicator. Some charting platforms have it, some don't. You'll have to ask your provider if they have it. It's called a block trades indicator. It's usually in the indicator section of your charting platform, and in Thinkorswim, or not Thinkorswim, but TradeStation here, they call them block trades. And if it's not native to your platform, you could also go into your trading platform's forums or discussion boards, and sometimes people post indicators on there and give them away for free that they've created. Some people are really good at programming, and they'll put them into those platforms, those discussion boards. All right, so anyway, those are some different ways to see if you have it for your platform, or you could have someone program it for you, worst case scenario. So notice that this is volume down here, but it looks a little different. There's not a volume bar under every single price bar. Why is that? Because this is only plotting the big orders, in this case, orders that have 20 contracts or more. And all this, there was no trades 20 contracts or more. And so putting this on here now, to me, is filtering out the retail volume and showing me the professional volume. And that is very, very powerful, because which would you rather trade? With the regular volume histogram, you're looking at all the volume, the retailers and the amateurs and the professionals and everybody. But what if we could just filter it down so we're only watching professional traders? Well, we can, and that's how we do it. So I think that's very powerful. Now, here's another even more advanced technique. So here's something I just came up with myself, although somebody else has probably done it. I don't know. But anyway, nobody taught me this. I just said, hey, I got an idea. So I put up 2 time and sales windows. One, I filter, now this one is a little different. I filtered this one to be only 10 contracts or more. Nothing less than 10 contracts will show here. On this other one, though, I made it so that nothing more than 2 contracts will show. Why did I do that? Because I want one window to show me professional volume, another window to show me amateur volume, and then compare the two. Most amateurs lose money. Most professionals make money. So I want to look for when they disagree. And you can see the prices are the same, 1205.75 all the way down, 1205.75, pretty much all the way down here. So price is the same, but these guys are selling and these guys are buying. Well, I mean, it's kind of an obvious answer to the question, which way do you want to go? I want to go long. I want to go long. I want to follow not only the money, I want to follow the smart money. And this is the smart money. So that is a really, really, really great tip for y'all, for all y'all. I should have charged you for that. So this approach is very robust, adaptable. Again, volume, man, it works no matter what market you're trading. All markets are based on supply demand. Don't care what it is. So it's a very robust methodology when you're combining price action with volume. Same thing with time intervals. Well, what time interval does it work best on is a question I get. Good question. I would just say that if you're trading a very thinly traded market, it's probably not going to work as well. You might not, in fact, some markets, you might not even have any professional volume trading certain stocks. I wouldn't trade them. I don't trade them. Why would I trade those? It's gonna chart. Here's another little tip for you. Chart patterns reflect the mentality of the people trading them. So when you get into stocks where there's no professional volume, no professional participation, and it's all amateurs, then you're going to see charts that look very chaotic, very random, very jittery, because that's the mentality of the people trading them. Professional traders are very systematic, very orderly, very rule-based, and then the charts are going to be very systematic and very orderly. I'd rather trade that. Easier to trade, and it makes sense. So here's what I got for you today. Unfortunately, I got nothing to sell you. After all that, I just gave you a bunch of stuff that I normally do sell. So, but I do have something for you, even though it's not going to cost you any money. I got something for you for free for being here today and honoring you for being here uh, in this presentation here today. Just go to topdogtrading.com/free. And what you'll see there is a mini course that you can have. And again, it follows along with this theme I've been really talking about for the last 45 minutes, how pros trade differently than amateurs. How pros trade different than amateurs. Okay, that's really been, I mean, we talked about 3 different volume patterns, of course, but throughout the whole thing, we had this similar theme. And that's what this course is about, give you more of that. So what you get is one of my favorite trade strategies. So it's not just going to be theory or just some general ideas. I'm actually going to give you a rock solid trade strategy. It's called the rubber band trade. And I'll give you all the rules, the filters, and my intention here is that you take that trade and start making some money. So instead of buying something from me, I want to just get you in a position where you're making some money first and test it out. Obviously, demo test it, simulate test it before you start trading it with real money. You're going to also get 5 video tutorials. They're just quick videos, about 20 minutes each. At the end is an interactive quiz to make sure that you really got it. And then also, I'm going to give you one of my indicators called the cycle indicator. And we didn't talk about this today, but it is so critical. We talked about price, we talked about volume. There's a third element you need, and that is time. If you think about it, a chart is a 2-dimensional object. Price along the right axis, time along the bottom axis. So a chart is a 2-dimensional object. That's all we got, 2 dimensions. So it's interesting because lots of people use price. Very few people have a timing tool on their charts, and that's disastrous. That means you're literally leaving off 50% of the information on the 2-dimensional object we call a chart. Well, how can you have a probability scenario if you're not even considering and you don't have a tool to measure 50% of the information, namely time? And this is why people get in too early, or they get in too late, or they're chasing the market, or they get stopped out. It's all because they don't know how to time their entries. In fact, the famous trader W.D. Gans said between time and price, time is more important than price. So I'm going to give you my timing indicator that goes into more detail. That's another hour-long presentation. So we do that through a free webinar, no price, no cost. Again, I'll show you how to set it up on your charts, and I'll show you how to trade it. So all you do is you just go to topdogtrading.com/free, and when you go there, guess what? Sign up there, and you'll get everything. Okay, so you don't have to go to 2 different places in order to get the different things, just everything all at one place right there. And yeah, sign up there and you'll get access to everything. So that's it for me. I am done and I finished, looks like 2 minutes early. So I'll leave it up to our moderators here. Do you want me to take some questions, or do we need to move on? Do you need a
Yeah,
little
sure. If
break?
there's any questions, go ahead and take them. We have some time.
Okay, excellent. All right. Any preguntas or fragins or heck, even questions? Tape them in now or forever hold your peace. So let's see. Oh, by the way, also, yeah, time frames is one of the most common questions that I get. What time frames does it work on? And I addressed that a little bit, but I do have a couple of articles on my blog that I wrote about that. So that's the best way to answer that. And what I'll do here, I'll just type my email address in because, well, my email address is not on the slide. So let's see here. I'm going to type my email address in here. So if you want those articles on how to time your, or not time, but the best time intervals, how to determine the best time intervals for your charts, just send me an email at barry@topdogtrading.com and I will reply to your email and send you the links on my blog to those two articles. I'd give them to you now, but I don't remember what the URLs are. So just send me an email and I'll look them up and I'll get those over to you. So, okay, good. All right. I think that's it. I'm not seeing any more questions. So, oh, wait a minute. We do have another one. Stephen, what platform on the do these tools work on? How do you set up the pro volume on your chart? Good question. You know, obviously you can do it on TradeStation because that's what my example was. I'm not familiar with all the trading platforms out there, Stephen, so I'm not sure. All I know is I use TradeStation. It has it, so you'd have to ask your um, trading platform. You know, contact their support team. They know their trading platform better than I do because, like I say, I just use TradeStation. I do use a few others, but what all platforms have this, I don't know. If they, so I would say do two things. Number one, ask your provider, your trading platform provider, and if they don't have it, then you might still be able to get it. Go to the discussion boards or the forums of your trading platform where people who use that trading platform get together and talk. And it's amazing. In fact, all of you really should probably do this. It is amazing how um, gracious people are in those forums. And a lot of people are very skilled at creating indicators and they've already done it and they've already posted them and just give them away for free. So if it's not native to your trading platform, check out the forums, discussion boards, and see if anybody has posted it. And if not, you can always post a question and say, hey, does anybody have this? Or, maybe can somebody program this? Sometimes people will program it for free or for a very small amount of money. So yeah, sorry, I just am not, I don't keep up on all the trading platforms out there. But those are some suggestions. You're very welcome. You're very welcome. Thank you for asking. All right. Well, I am done. So I'm getting back to see what's going on with the markets here today and try to make some more money. So Dow is at down 163.74 as I speak right now. So let's go see if what else is going to happen here. And I just thank you all for being here for the presentation today. Hope you enjoyed it. I hope you got some value out of it. Go get my freebie stuff. It's great. It's better than a lot of paid stuff. I think hopefully you got a lot of value out of what I presented to you today for free as well. And look forward to hearing from you and working with you. So, and thank you so much, everybody. Have a great rest of the day and a great rest of the week.